I'm going to go ahead and record. Okay, so for chapter 3, we've gone over the journal entries of T accounts, the trial balance in Monopoly. You did all of that, plus you did your financial statements and 2 ratios, current ratio and net income percent. So here we have adjustments and we have our closing entries. Okay, so you have 7 entries to learn for the adjustments, and you've already learned 13 entries in chapter 3. So as you prepare for the first exam next week, I would encourage everybody to just make a flashcard, put all 13 journal entries on 13 flashcards, put the prompt on one side and the journal entry on the other, and just drill on your journal entries. And that'll help you with your debits and credits. And also make sure to do your account identification quiz. And that's going to help you as well. I want to just check that really quick. So we can, oops, I don't want this on the, let me stop sharing. I don't need your grade on the, on the video, even though it's perfect. So, okay. All right. So we've got, at the end of, so in units and modules in chapter 3, we have the account identification quiz.
Mm-hmm.
Have you taken a look at that yet? Have you done that yet?
Yeah. I did it yesterday.
Oh, great. Okay. So that's the other way that you'll be preparing for the exam, is drilling on what statement, whether it's a debit or credit balance, and then whether we, or neither, like with retained earnings is not on the income, I'm sorry, dividends are not on the income statement or the balance sheet. All right. So we'll do a new share and we'll go back from that. Cancel that. All right, now can you see my PowerPoint, Asa?
Yes, I can.
Perfect, okay. So we have 7 journal entries. We have something called prepaids, where the company has paid for something in advance. And that's 4 journal entries. And then we have 3 journal entries for accruals, okay? And this is, some of it in my classroom, students will say, we bought a piece of equipment or we took out a loan. When do we recognize the interest? Well, in chapter 4, we recognize the interest on a loan for a note payable, okay? So we're always looking at the point in time when we issue financial statements. What events have occurred that we need to make sure show up on our financial statements? And they are things like interest expense, depreciation expense, supplies expense. We want to make sure that we record what we've used up or what cost we owe that we haven't recorded up to now. Okay. And this is called accrual accounting, and it's called recognizing the revenue that was earned during the period and any costs that we incurred. Okay. So we have financial statements over a period of time. It's arbitrary, but people want to know, as of this date, what's our sales as of the end of the month? As of this date, what are our expenses? And then, of course, revenue minus expenses, what is profit? Okay. All right, so accrual, that's what accrual accounting is. We do not do accrual accounting in our personal lives at all. We do cash accounting, but in businesses, we can't do that. And I'm going to make a case why we can't do it. So we say revenue recognized when earned, not necessarily when the cash was received. I mean, if you're standing at a coffee stand and somebody buys a cup of coffee and they hand you $3, you give them the coffee, they gave you cash, you gave them coffee, easy to recognize revenue. But if you come up to the coffee stand and they say, I want to buy a coffee card with $25 on it, they give you $25, but they only drink 1 cup of coffee because they're going to come back every day and get another cup of coffee and use their card that they've prepaid for. Then the question is, when do we recognize the revenue? When can the coffee stand call it a revenue? And then expenses are recognized when they're incurred, not necessarily when they've been paid. Okay. All right. If we were to do cash accounting, we'd just say wherever the money is, we follow it. So if we got paid, it's revenue. If we spent money, it's expense. We can't do that with GAAP, generally accepted accounting principles. Okay. Okay. All right. So typically we might say, like I said, with a coffee example, we sell, well, you're not going to sell a $100 cup of coffee, but you sell something for $100, you recognize the revenue. But cash might be received later. So let's say you sell something for $100, the customer takes it, okay, but they tell you, send me a bill. There's no cash exchanged. And then later you get the, or there's a third, so later you'd be paid, sorry, go back. Later you'll be paid for that money that they owe you. And we did that transaction in chapter 3 with the worksheet. So then we say, what if a customer prepays you, like my coffee example, where they buy the coffee card? Well, let's say they buy a coffee card for $100. In that case, we use this account unearned revenue. We haven't earned it yet, so it is a liability. Okay. All right. So for example, the company provides 20 hours of advertising services and earns $2,000 in service revenue. During that same period, the company has to recognize any expenses they incurred that help them earn that revenue, salary expense, or if they used any supplies. Okay. So here's my argument for accrual accounting. Okay. A man starts a building, starts a company. It's a painting company. He paints buildings called Sky High Painting. The company is started in the last month of the calendar year, and he follows the calendar year for his fiscal year. You know, companies get to choose. They don't have to do the calendar year as their fiscal year. They can, in there, like in education, our year ends June 30th. It starts July 1st. So it's more like the academic calendar. Okay. He gets the job to paint a building in downtown Bellevue. He hires the employees and he buys the paint. They paint the building. He pays his employees and he pays for the supplies, the paint. And that's $50,000 cash out, down. However, the customer doesn't pay him, but he does bill the customer on the last day of the year, $80,000. Then he decides to leave the country and his family sells the business. You know, how many people would do that after 1 month? Nobody, but anyway, makes a good example. Okay, so year one, if he's doing, go to this bottom row here, if he's doing cash accounting, he can't call anything revenue because he hasn't been paid. He won't be paid until January, which would be year 2, even though it's just 1 month apart, because his fiscal year and calendar year in December 31st, if he does financial statements, if he does an income statement for year 1, even though it's only 1 month, that'll be all the activity for year 1. So he would record revenue for 0, but since he paid expenses, that would be 50, and he'd have a loss of 50, okay. Year 2, he'd have revenue because he'd be paid, but he wouldn't have any expenses because he shut down the business. So we'd have income of 80. And that isn't good matching. That doesn't tell us the real story of the business. So that is the argument for why we do accrual accounting, which is in the first row. He would recognize the revenue, debit accounts receivable, credit, sales revenue, service revenue. He's already recognized his expense, salary expense, paint expense, et cetera, with a net income of 30,000. Year 2, he's shut the business down, so there would be no activity. Okay, so what does this tell us? This tells us it's a profitable business year 1. He made a really good profit. And when he gets ready to sell the business, people might say, hey, that's a great business. You've got good employees, you've got good customers. Maybe there's some repeat business coming down the road. And so it gives us the right information. Did we make money or not? Okay. So we're always trying to do that matching so we can say, what was the activity in this month? How did it work? Cash accounting doesn't give us that information. Cash accounting is just, where's the money? And when we get at the end of accounting 202, when you do the cash flow report, that's going to be more like the cash accounting of the income statement. But for now, we want the income statement. The income statement serves a different purpose than the cash flow report. We don't want to just focus on cash. We want to focus on how much revenue we've earned and whether we're making money or not. Okay. So it tells us the real story of how we're doing. Okay. So we have to do adjusting journal entries. And every month, accountants look at the statements and decide what adjusting journal entries do we need to make. Every single adjusting journal entry, you're going to learn 7, 4 prepaids and 3 accruals. Every single journal entry is going to have at least 1 balance sheet account and 1 income statement account. Okay. So if you, and it's never, never, never on these 7 journal entries are never going to have cash ever. Okay. They just won't. Okay. So here's an example. A company buys supplies for $900 on October 3rd. Okay. Could you tell me, Beza, could you tell me what the journal entry would be if they buy supplies on October 3rd for $900? What would be the debit? What would be the credit?
Well, the credit's going to be cash.
Mm-hmm.
And then the debit is going to be the supplies.
Correct. Yay. All right. So he buys those. But at the end of the month, they go into the supply room and they count the supplies, and that only adds up to $250 of supplies on hand. So how much, if you have a calculator, how much supplies did they use up in the month?
Let me see. 650.
Exactly. So you have to, you've got that money in the T account supplies at 900. And so we're going to learn the adjusting journal entries to get it out of the T account. But not yet. Okay. So revenue recognized in the period they're earned, expenses recognized in the period they're incurred. We will, hang on, I got to stand up. I've been sitting too long. Adjusting entries need to ensure that everything matched up. Okay. So we're going to have a category called prepaids and a category called accrual. Prepaids have 4 adjusting entries. 3 of them impact expense accounts. 1 of them impacts a revenue account. And then accruals, we just have 3. There's other examples of accruals, and there's other examples of prepaids, but it'll follow the same logic. Okay. Okay. So if you printed out my course pack, this is in it. Now, I want to point out a couple things. This is a trial balance, and you would never make a trial balance like this because if you don't have a balance, you just wouldn't print out the account. And so software programs are designed to only print out the accounts with an account balance. But I wanted to show the whole chart of accounts here because we're going to use some of these. So if you feel like writing down, we've got 4 accounts that'll be affected or that are going to be looked at for an adjustment. So in accounting, we would say, oh, we've got 4 accounts to look at. Do we need to make any adjustments? Supplies, prepaid rent, equipment, unearned revenue. Okay. So you don't know anything yet. I mean, you have to dig into the data in a real accounting department, but we'll just walk through it here with the data that they give us. Okay. So the whole idea of the prepaid expenses is something has been prepaid. So there is an account with a balance in it on your balance sheet. So let's look back at this chart of account again. What kind of account is supplies? What category is it?
It's going to be in the assets.
Correct. And then prepaid rent is also an asset. What about equipment?
That's going to be in the property or equipment.
Yeah, and it's great. You took it a step further. That's great. It's also an asset and it's under property, plant, and equipment. By the way, prepaid insurance is also, just like prepaid rent, is also an asset. And think about it, if you've ever gone into an apartment and they've asked you for your first and your last month's rent with the idea that when you leave, you don't have to pay your last month. Okay. Assets stop right under accumulated depreciation, which right now has a 0 balance. Then I've got 3 payable accounts, then an unearned revenue, then salaries payable. Okay, so all of those are liabilities because they go in order. Okay, then we've got common stock retained earnings, which is stockholders' equity accounts, then dividends, and then we've got 1 revenue account and a whole lot of expense accounts. Okay, all right. So prepayments occur with supplies, could be insurance, could be rent, advertising, supplies, maintenance on equipment, fixed assets. Okay, so we look at the prepaids and we say, we bought this stuff. Has any of it expired or been used up? Okay, so if so, we do that adjusting journal entry to record how an item was on the balance sheet, was an asset, and now we're moving the cost over to the expense, to an expense account on the income statement. And then whatever's left still has future value, hasn't been used up yet. So in my supplies example, we'd used up $650 worth of supplies, but we had $250 left. Okay, so these transactions were in chapter 3 PowerPoints. Okay, so we bought supplies for no other transactions occurred. Why do I have 7? Oh, there we go. Okay. We bought supplies costing $1,550. So when you get a transaction in your homework in chapter 4, you don't have to book the original journal entry. The way it'll read is it'll say, unless it says to, but typically it'll say, this happened, now do the adjusting journal entry. Okay, so this is exactly like the one we just looked at. We had $1,550 in the supplies account, but now we've done a count. It's a month later, and we only have 800. So how much of the supplies have we used up?
That will be 750.
Perfect. Okay. So the adjusting journal entry is to reduce supplies by 750. Okay. Debit or credit to reduce the asset supplies?
That's credited.
Yay. Okay. So it's going to be a credit to supplies and a debit to supplies expense. All right. Okay. So we've got debit supplies, credit, debit supplies, expense. Now, those 2 accounts look really, really similar. They're completely different. One's an asset. It has future value. It represents something you can go out and count. Supplies expense is something we've used up, and it goes on the income statement. And theoretically, it helped us create revenue. You know, maybe it was in the old days for advertising, it would have been, you know, paint and ink and paper and all of that stuff. Now so much is digital, so you wouldn't have the same supplies. But this 800 that's left in supplies, it had to be supported by an actual count, an actual inventory account. Okay. All right. So again, they're saying, remember, this happened in the chapter 3 PowerPoint, Emerald City. So here's the second adjustment. They prepaid 4 months of rent in advance. Monthly rent is $1,100, but the prepayment was for $4,400 because they paid for 4 months. All right, now it's the end of the month and 1 month of rent has been used up. Okay. They had to put the whole $4,400 on their books as an asset on January 2nd because they hadn't used up the rent yet. And that's kind of a weird concept. Okay. So now you want to lower prepaid rent by $1,100 to reflect the January rent. So what do you think that journal entry is going to be for prepaid rent?
Like where does it go in the balance sheet? Or
what's the debit? What's the credit?
Oh, well, I think there's going to be a cash that's going to be credited. And then there's also going to be, wait, I'm not sure what's debited though.
So no cash. They already bought the rent, paid for the
No.
in the first transaction. So there won't be any cash in this transaction.
Oh, okay. Yeah, that makes sense actually.
So if I want you to visualize a T account, prepaid rent, it's an
Mhm.
asset, and it has $4,400 on the debit side. Now it's end of the month. We got to recognize 1 month rent. So we got to reduce prepaid rent.
Oh, so the 1,100 is going to be credited.
To which
It's just, I think, expense.
nope.
Rent.
I'll put the T accounts up. So you have prepaid rent here.
Mhm.
You want to recognize, you want to reduce it by 1,100 and get to 3,300. Okay. And you're going to charge it to rent expense
Oh,
for the January rent. Okay. So you had 4,400, you originally back on January 2nd, you debited prepaid rent 4,400 and you credited cash. Now it's the end of the month and we say, hey, we got to recognize that rent expense because we used it up. I mean, it's a funny concept. We consumed it by being in the building for a month. Next, you're going to do the same journal entry until you've done all of them. Okay. And then after 4 months, maybe your landlord will let you just pay each month. Okay. So if I look at this account and I have $3,300 at the end of January, and I know that monthly rent is $1,100, I know I have 3 more months of prepaid rent in there. And I'll have to make an adjustment February, March, and April. We don't prepay rent much except for that last month's rent. Okay. All right, here's depreciation. Okay, on January, so we bought a piece of equipment for $5,600 at the beginning of the month. Now, I got to tell you about depreciation. It's a funny concept. So if you have an asset like a car, it will lose value the more you drive it, right? And so in accounting, you can't just write an asset off. If you say, oh, it's got a 5-year life, you can't just say equipment expense. There is no account equipment expense. There's an asset account called equipment, and the expense account is called depreciation expense, and you actually write off the asset over its life. Okay, so writing off means you expense it. Okay, so let's look at this one. Oh, there it goes. Okay, on January 2nd, they bought the asset for $5,600, and then the problem will tell you how much to depreciate it, or they'll tell you how to calculate it. Like it's got a 10-year life and you need to depreciate 1 month or something. And then you just do the math for that. But in this problem, we say it depreciates $85 a month. Okay. So the journal entry is going to be debit, depreciation expense, credit, accumulated depreciation. Okay. So we use this depreciation expense account. That'll show up on the income statement. But accumulated depreciation account will be paired like a twin. It'll be paired with the equipment account. So let's look at this. So I showed you way back here. I showed you the equipment account and I said, here's accumulated depreciation. There's nothing there yet. But from now on, every month it will grow. That's why it's called accumulated depreciation. Okay. It'll grow. Right now it's $85. Next month it'll be 85 plus another 85, and it'll just keep growing for the 5 years or 10 years, however long the equipment's going to last. We look at the balance sheet, and if you look at your balance sheets for the companies you got, it might show accumulated depreciation separately. If not, it'll show it in the annual report. Less accumulated depreciation, and then we have a new concept here called net book value. Okay, so the bigger accumulated depreciation is, you know the asset is getting old. Okay, so I want to tell you, I'm sure you've been on a plane. Have you been on a plane recently?
Yes, I have.
So like a Boeing 737, okay? It costs like $140 million, okay? What if after you got on the plane, the flight attendant made an announcement? This plane cost, welcome to Alaska Airlines. This plane cost $140 million and the balance in its accumulated depreciation is $139 million. What would that do to you? Would that make you feel any way?
I would be a little confused.
Well, what it would mean is it's really old plane. So if you bought it, so if accumulated depreciation grew to like 5,500, that just tells us it's almost fully depreciated. It's at the end of its life. Okay. So if you're on a plane, you don't want to know that information. Okay. All right. So let's look at one more and then no, let's do something else. Do you want to do a little practice one?
Sure, yeah.
Do that. Let's go back to that. Let's go to chapter 4. See if we can do end review and practice, end of chapter, brief exercises. Okay. Okay. All right, here we go. How about this one? There's too many of them. Let's do 4-5. Leahy Advertising shows supplies 8,800 and supplies expense of 0. On December 31st, there are 1,100 of supplies on hand. Prepare the adjusting entries. And let's just stop there. Prepare the adjusting entries. So take a minute and then just throw it in the chat.
Okay.
And thanks for sticking around, Beza. I appreciate it. It's I mean, you're welcome to leave if you need to be somewhere, but anytime.
Oh, I don't.
Make you stay, but I thought it'd be a good opportunity to walk through some of these.
It is. I appreciate it.
Zoom recording. Okay, so the question is saying on December 31st, and that's what's tricky about these questions where you say, which one are they asking me for, the original one or the adjustment? We're asking for the adjustment. So they already have, if you visualize your T account, they already have 8,800 in the debit side of the T account.
Okay.
Now, when they physically count the supplies, they have 1,100. So the question, the adjusting entry is for how much they used up in the supplies.
All right.
Do what to the supplies account?
We will be putting 7,700 in the supplies account.
Debit or credit?
And that's
increase or decrease?
That's decreasing.
Yes. So 1,100, 7,700, right?
Yeah.
So to decrease an asset, is it a debit or a credit?
If it's decreasing, then it's credited.
Great. Okay, so you've got half your journal entry. So we're taking it off the balance sheet. We're taking it out of the assets because we've used it up.
Mm-hmm.
So where does it go on the income statement?
Well, if is it like depreciated?
You had the account right before.
So if we used up the supplies, I'm not sure actually.
Okay.
I was about to say like depreciated something, but I don't think.
So let's go back. Let's go back to the supplies journal entry because I think that's going to be helpful. Okay. So we're going to do here. So the way these work, let's do it and share screen. I'm never sure if on these screen shares. Okay. So in this example for supplies, and you're just learning this for the first time. So you have different numbers here, but in your problem, you had 8,800 in the supplies account, but now you count 1,100. And you said, well, we used up 7,700. So we're going to reduce supplies.
Mm-hmm.
And then it has to go to expense. Okay. It's not revenue, so it has to go to expense. It has to go somewhere, and it's going onto the income statement. Okay.
Are we talking about the 7,700 here?
Correct.
Okay.
So you have the same journal entry, supplies, expense, supplies, 7,700, 7,700. And we'll go back to that. So you had 8,800, you had bought them, but you only have 1,100 now. So we've used up 7,700. So we debit supplies expense and we reduce supplies. Okay. Okay. So this one is for depreciation. Let's look at this one. I think it's good to do this. At the end of the first year, the trial balance shows equipment, 22,000 and a 0 balance in accumulated depreciation equipment. And also a 0 balance in depreciation expense. Depreciation for the first year is $2,750. So they're telling you the dollar amount. So can you give me the journal entry?
So, okay, so I think the depreciated expense is going to be 2,750 debited.
Great.
And then the accumulated depreciation is going to be 2,750 credited.
That's perfect. Yeah, you got it.
Cool.
And let's do one more. And then on July, now it's going to be the prepaid. Now, I think the example we did in class was for rent, but the same logic holds. So let's take a quick look at the prepaid that we did for rent. So we had rent of 4,400 and we said 1 month has gone by, so we got to reduce it by 1,100. So we reduce prepaid rent by 1,100 and then we get it off of the balance sheet and it goes onto the income statement. We've used something up, so that means it's an expense. So it's rent expense, okay? So then in this example, we're going to have on July 1st, Ling Company pays $12,400 for a 2-year insurance policy. So where you had the words rent before, you're going to have insurance now, okay? Ling Company pays $12,000 to Marsh. Both companies have fiscal years ending. So we're doing the books for the person who bought the insurance, Ling Company. Make the journal entry on July 1st and also on July 31st. So in this problem, they're asking you for the original journal entry when they bought the insurance, and then they're asking you for the adjusting entry on December 31st, okay? So don't worry about the dollar amounts right now. When they buy prepaid insurance and they pay cash, what would the journal entry be?
Well, the prepaid rent is going to be debited, like in the
Correct. Prepaid
first
insurance. Yeah.
Yeah.
Not rent, but insurance. Yeah.
Insurance, sorry. Yeah. And then later on,
No, stay there, stay there. They want the original journal entry this time. They have to ask for it if they want it, but typically they only want the adjusting one. So when they bought the insurance, they debited prepaid insurance. What did they credit?
Oh, can I see the screen?
Oh man, am I showing the wrong screen? Thought I fixed it. Yes, you may see the screen. Now, can you see it?
Yes, I can.
Okay, sorry about that. July 1st, they paid for insurance. So when the problem doesn't tell you how they paid for something,
Is it account?
always assume it's cash.
Oh,
They have to tell you they bought it on credit.
okay.
So
then the cash is going to be credited.
Yeah. So that's the original entry. So that gets the money into your prepaid insurance account, and it's it is $12,400.
Yeah.
Okay. Now it's December. Don't worry about the dollar amounts yet. What's the adjusting journal entry going to be? What's going to be debited? What's going to be credited?
Well,
so you're going to recognize that you've used up some of that prepaid insurance. So you're going to reduce prepaid insurance.
does it say like for how long they reduced it? I can't.
Don't worry about the dollar amounts. Just give me the
Okay.
just give me the accounts, and then we'll walk through the dollar amounts.
Well, in that case, the insurance expense is going to be debited, and then the prepaid insurance, I think, is going to be credited.
Yes. Good. Okay.
Okay.
Get the accounts first, and then worry about the dollar amounts. Okay. So I want you to visualize. Let's see. You had 12,400 for a 2-year policy starting in July. Okay. So 2-year policy, but now from July to December is 6 months. So it's half a year. Okay. So this 12,400 is for 2 years. Can you see the calculator here?
I have a calculator.
Can you see mine on the screen?
No, I can't.
All right, let's do this. I want my calculator. Now, can you see it?
Yes, I can.
Okay, so you have 12,400, okay? But it's for 2 years. So how much a year is it? What's the formula for that?
Well, if we want to know how much we paid in like half a year, we're going to divide it by 4.
It's for 2 years.
2 years.
Track, but so why 4? Go ahead.
Oh, okay. That we're just going to divide it by 2.
Well, 4 would work too, but you're jumping.
Yeah.
So annually, it's going to be 6,200.
Yeah.
So from July to December is half a year. So you divide it by 2 again. Okay. So the answer is going to be 3,100. Right.
Yeah.
Does that make sense? So the journal entry would be insurance expense, prepaid insurance, 3,100 for both of those. Okay.
Yeah, that makes sense.
I have to hand it to you, Beza. You're doing accounting on the fly as opposed to just kind of listening. I can do one more journal entry with you if you want, or we can call it quits. So got a little bit of a late start, but
we can do another one.
okay, let's do the last one. Can you see my slides?
Yes, I can.
Thank you. Okay, the last prepaid is unearned revenue, and that means that the customer pays ahead of time. Like I gave the example with somebody buying a $100 Starbucks card or coffee card. They prepay. So again, it's a prepayment, but instead of being for an expense, it's going to be for revenue. Okay. So what we say is, who does unearned revenue? So like if you buy an airline ticket, you prepay, but you don't get your trip for maybe a month or 2.
Yeah.
Okay. So they can't say, oh, that was a sale in January when you're really not traveling until March. They have to hold the money. They debit cash because they got money from you, and they credit a liability account, unearned revenue. But as soon as they've provided the service to you, at the end of March, they're going to recognize that revenue. And so the adjusting entry is how they recognize the revenue.
Mhm.
Groups that do this would be like if you bought a ticket to a Mariners game in a month, or if you bought a season ticket to a game, okay, to a series of games, right? So the company loves customers who want to prepay them because then they get the cash early and they can earn interest. But they cannot call it revenue. It sits on the balance sheet as a liability. It's not money that they owe you, but it's service that they owe you, or a product if you prepay for a product.
Mm.
So we had this in chapter 3 PowerPoints. Emerald City accepted an advance from Joe's Organic Grocery Store for design work. They're an advertising creative group to be done by the end of the month. Unearned revenue shows a balance of $900 in the trial balance. So if we went back to that trial balance, we'd see it has a credit balance of $900. All right. But analysis reveals that the company actually earned $650 of this work in January. So how do we know that? We say, oh, we created these ads, this creative work. We created these posters, and the ad ran in the online Seattle Times, or it ran on Facebook or Google, wherever. And so we've earned the revenue. We did the work provided. We did $650 worth of the work provided. Okay. So what we say is, and I'm just going to show you this journal entry. So in chapter 3 slides, we had booked sales of 1,300, additional sales of 4,700. But now we're in chapter 4 and we're saying, oh, look, we earned $650 of revenue, design work revenue. Okay.
Mm.
All right. So debit unearned revenue, because we want to reduce the unearned revenue account because it's not unearned. And now we're going to move it to the income statement, but it's not an expense, it's revenue. So we're going to call it revenue. So unearned revenue, 650, reduces the liability, and we increase sales by 650 because the company earned the additional 650 in the month of January. Okay. So this is kind of how the problems will read. It has a balance, but they've earned this much. So let's just take a really quick look at the Wiley Plus. Can you see Wiley Plus now?
Yeah, I can.
Okay, great. I just don't really get Zoom. Sometimes you can see it, sometimes not. Okay, so using the data, journalize, adjusting. Okay, so Marsh Company, this is a little bit confusing because we've got 2 characters here, okay? In number 7, we recorded the purchasing company, Ling, who said, we paid for this insurance policy in advance, and now 6 months have gone by, we've earned the insurance, okay? We've expensed the insurance. That's the entry you gave me. Now we'll look at it from the seller's point of view, okay? So let's pretend we're Marsh Company now. Marsh Company was paid $12,400 of cash, but instead they can't call it revenue yet because it's July 1st, so they called it unearned revenue. Now, 6 months later, they're going to recognize the revenue, and that's going to be that same journal entry, debit unearned revenue, credit service revenue, and it's going to be the same problem that we had before where we said it's 4 divided by 2, divided by 2, it's going to be $3,100 of revenue earned, okay? So they prepaid, the customer prepaid, so the seller, the insurance agency, debited cash, credited unearned revenue. Now it's 6 months later and they're saying, well, we've earned that revenue. Debit unearned revenue, credit service revenue, and it's going to be for $3,100. Okay. That one's advanced, but the journal entry. So my trick for chapter 4, Beza, is it's 7 journal entries for for closing journal entries. Just really realize that when you're reading a problem, the adjusting journal entry isn't going to change. It's just going to be the dollar amounts that change. There might be a few word vocabulary changes here and there, but so.
Okay.
Okay. So thank you for